Passive income in the crypto space has emerged as a compelling option for investors who want to grow their wealth without the demands of daily trading. Unlike traditional investing, passive crypto strategies allow individuals to earn rewards or interest simply by holding or staking their assets. This approach is particularly attractive to those seeking financial freedom, as it offers the potential for steady returns with less time and effort. By leveraging innovative blockchain technologies, investors can participate in decentralized finance platforms, lending protocols, and staking pools. These opportunities make it possible to generate income while minimizing active involvement. As a result, passive income in crypto continues to gain popularity among those looking for a more hands-off way to build their financial future. Passive income refers to earnings that are generated with minimal ongoing effort. In the context of cryptocurrency, this might include activities like staking coins, earning interest through lending platforms, or receiving rewards from holding certain tokens. Unlike passive income, active trading requires constant attention and decision-making, as traders buy and sell assets to capitalize on short-term price movements. Active trading can be time-consuming and often involves higher risk due to market volatility. Passive income strategies, on the other hand, are designed to provide steady returns over time without the need for frequent transactions. Understanding the distinction between these approaches can help investors choose the strategy that best aligns with their goals and risk tolerance. Staking is a process that allows cryptocurrency holders to participate in the operation of a blockchain network by locking up their coins. In return, they can earn rewards, typically in the form of additional coins. Popular cryptocurrencies that support staking include Ethereum, Cardano, Solana, and Polkadot, among others. The potential rewards from staking depend on factors such as the coin's protocol, the amount staked, and network conditions. However, staking also carries risks, including price volatility, potential loss of funds due to network attacks, and the possibility of coins being locked for a certain period. Understanding both the benefits and the risks is essential before deciding to stake your assets. Yield farming and liquidity provision are innovative ways for individuals to earn passive income within the decentralized finance ecosystem. By supplying assets to decentralized exchanges and protocols, users help facilitate trading and lending activities. In return, they receive rewards, often in the form of transaction fees or protocol-specific tokens. These incentives are designed to encourage more participants to contribute liquidity, which is essential for the smooth operation of these platforms. While the potential for earnings can be attractive, it's important to understand the risks involved, such as impermanent loss and smart contract vulnerabilities. Careful research and risk management are crucial for anyone considering yield farming or liquidity provision. As the landscape continues to evolve, these strategies remain central to the growth and sustainability of decentralized finance. Crypto lending platforms offer a straightforward way for users to earn passive income on their digital assets. By depositing cryptocurrencies into these platforms, you can lend your holdings to borrowers and receive interest payments in return. The process typically involves selecting a platform, transferring your assets, and choosing the terms of your loan, such as duration and interest rate. Unlike active trading, lending does not require constant monitoring of market movements. Your assets are securely held by the platform, and interest is paid out at regular intervals. This method allows you to grow your portfolio with minimal effort, making it an attractive option for those seeking low-maintenance investment strategies. Crypto savings accounts have emerged as a popular way for individuals to earn passive income on their digital assets. These accounts are typically offered by centralized platforms, which allow users to deposit cryptocurrencies such as Bitcoin, Ethereum, or stablecoins. In exchange for depositing their funds, users receive fixed interest rates, often higher than those found in traditional banking. The platforms manage these assets, lending them out or using them in other financial activities to generate returns. This model provides a straightforward entry point for those looking to grow their crypto holdings without actively trading. However, it's important to understand how these platforms operate and the risks involved before participating. As the crypto landscape evolves, these savings accounts continue to attract attention from both new and experienced investors. When building passive income streams in the world of cryptocurrency, it's important to be aware of several key risks and considerations. Security is paramount, as digital assets are often targeted by hackers and scams, making robust protection measures essential. Platform reliability also plays a crucial role. Choosing trustworthy and well-established platforms can help minimize the risk of technical failures or sudden shutdowns. Additionally, market volatility is a constant factor in crypto, with prices capable of fluctuating dramatically in short periods. These swings can impact the value of your investments and the returns you receive. Carefully assessing these risks and staying informed can help you make more resilient decisions as you pursue passive income opportunities in the crypto space. Diversifying your passive income strategies is essential for building long-term financial stability. By spreading investments across different asset classes, such as real estate, stocks, and digital ventures, you can reduce exposure to market fluctuations and sector-specific risks. Consider combining traditional options like dividend-paying stocks with newer opportunities, such as peer-to-peer lending or creating online content. Regularly reviewing and rebalancing your portfolio helps ensure that your investments remain aligned with your goals and risk tolerance. It's also important to research each strategy thoroughly and stay informed about market trends. By taking a balanced approach and not relying on a single source, you can maximize returns and safeguard your income against unexpected changes. In summary, exploring passive income opportunities in the crypto space can be both exciting and rewarding. However, it's essential to remain cautious and informed, as the landscape is constantly evolving and not without risks. Take the time to thoroughly research any method or platform before making a commitment. Understanding the potential benefits and pitfalls will help you make smarter decisions and protect your investments. By staying vigilant and well-informed, you can navigate the world of crypto passive income with greater confidence and security.